Welcome to the Daily Drawdown, where leverage, chips, and rates are moving markets fast. The clean AI bull story just hit a messier phase. Memory stocks rolled over, leverage turned a pullback into a cascade, and the market is starting to ask whether AI returns can actually justify the spend. The most important move was in memory. After a huge run with some semiconductor names up several 100% from late 2022 lows, the trade snapped hard. DRAM-focused ETFs dropped about 14% in a session, and major Korean memory names fell more than 12%. What changed is the debate around mix, margins, and demand visibility. Companies including SK Hynix signaled more emphasis on DDR5 and mainstream DRAM rather than only the premium HBM products tied most directly to AI servers. That matters because investors had been paying for scarcity and extraordinary pricing power. Micron just printed gross margins near 80% versus roughly 33% over its 10-year average. If supply expands or if foundry and capacity arrangements get more expensive, those margins can fall a long way very quickly. The key watch item now is whether this is simple profit optimization by suppliers or the first sign that hyperscaler and GPU demand is losing some urgency at the margin. South Korea showed how concentrated and leveraged this trade has become. The Kospi fell roughly 10% intraday, circuit breakers hit, and trading was halted after sharp drops in SK Hynix and Samsung. Because the market is so heavily tied to a handful of chip names, a semiconductor shock becomes a national index shock. Retail leverage made it worse. Margin debt in Korea reached a record 38.5 trillion won, and regulators admitted they moved too quickly in approving leveraged chip ETFs. This was not just a local issue. Barclays estimated leveraged ETF rebalancing flows could reach around $20 billion in a day, and Soxel fell roughly 23% in the unwind. Similar leverage buildups are showing up in Taiwan and elsewhere, which means overnight moves are getting structurally more violent. For single stock risk, Micron is near the center of the board. The stock has re-rated sharply, and the market now cares less about the next quarter than about 2027 and beyond. Analysts want to know whether current AI memory economics are durable. Once more wafer supply comes on and long-term foundry deals reset the cost base. Cerebras has a similar issue in a more extreme form. The IPO drew major interest, then turned volatile fast. Revenue is expected around $180 to $193 million, roughly doubling year over year, but customer concentration is the real story. OpenAI represents the bulk of backlog and reported revenue, and scaling depends heavily on TSMC capacity, plus finding more take-or-pay partners like AWS. Gross margins are also expected to compress from about 47% toward the mid-30s as capacity expands. In both names, the same question applies. Are investors paying for a durable platform or for peak scarcity? At the index level, the big macro issue is that 7 mega-cap tech firms are set to spend roughly $750 billion on AI this year, up about 80% from a year ago. That spend is being financed partly with a surge in borrowing. Debt-to-free cash flow ratios are back at levels not seen since the dot-com era, and large bond issuance from companies including Alphabet, Oracle, Amazon, and SpaceX tells you funding conditions matter again. Why this matters now is simple. If Treasury yields stay high, or if AI pricing power erodes, those returns on capital get much harder to defend. Cheaper Chinese models such as DeepSeek are part of that pressure. If cloud providers offer lower-cost alternatives to serve price-sensitive demand, the economic case for premium AI infrastructure gets less clean. That is why investors are starting to favor the full-stack players with the most control over chips, data centers, and distribution. Alphabet is viewed as durable on that basis. Microsoft still has distribution strength, but it is managing a more complicated seat-based model and appears pragmatic about using lower-cost external models when needed. Even if AI demand holds up, supply chain execution is far from solved. Industry leaders are warning that semiconductor and data center capacity may struggle to scale through 2028 and 2029. The risk runs both ways. Underbuild and demand gets constrained, overbuild and investors eat a painful re-rating on stranded capacity. That is pushing attention beyond chips and toward power, land, and infrastructure. Compute is increasingly being treated like a utility, with projections calling for more than 100 gigawatts of data center power demand over the next decade. That makes natural gas, pipelines, turbines, permits, cooling, and strategically located land relevant AI exposures in their own right. The upstream planning race is no longer theoretical. The policy backdrop is not helping risk appetite. Markets are still pricing a meaningful chance of another Fed hike, while the front end of the Treasury curve has moved much more sharply than the long end this year. That keeps pressure on duration, leverage, and any valuation built on perfect execution. Private markets are showing the strain too. Apollo capped redemptions in a flagship private credit fund after requests reached roughly 16.8%, or about $700 million, and other managers have used similar gates. The practical read-through is that liquidity assumptions are being tested. That may not break the asset class, but it raises the odds of pressure showing up over the next few quarters as investors reassess risk and the effects of higher rates. SpaceX is worth watching for supply and sentiment. The stock has traded below IPO levels on thin float, put activity has picked up ahead of lockup expirations, and a large bond raise underscores how capital-intensive the business remains. In retail, there was a more constructive surprise. Target posted stronger same-store sales and drew upgrades, while Prime Day spending forecasts suggest consumers are still willing to spend, even if the gains are not spread evenly across the sector. In energy, U.S. waivers for Iranian crude exports and heavy flows through Hormuz-pressured oil, with some desks now looking for Brent in the mid-70s or lower by late summer, but positioning is short enough that any disruption could reverse that move quickly. And one niche area still building real momentum is quantum hardware and sensors. A new White House push on quantum sensing for navigation and health monitoring adds policy support to a part of deep tech that is finally showing tangible engineering progress. That is the drawdown to watch right now. Leverage is unwinding, AI economics are being questioned, and rates are not offering relief. You are listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.